Fresh data casts doubt over the strength of the US economy. Welcome to Market Insight. I'm Ludovica Brignola. ISM Services PMI unexpectedly contracted in June, dropping to a 4-year low. Factory orders slumped, while ADP private payrolls also pointed to a cooling job market, as did weekly jobless claims. What does it mean for the Fed and for markets? Well, to answer all that and more, joining me now is Victoria Beals. She is Chief Investment Strategist at Banrion Capital Management. Thank you for being with us today. Right, so ISM Services was the worst print in 4 years. What does it say about the state of the economy entering the third quarter?
Well, first, I think one of the few things that it says is that we are, in terms of jobless reports or jobless claims, that we are continuing to see a slowdown in the economy due to the onward pressures of interest rates, particularly that, again, as we've had like a very booming, bustling economy for the past couple of years, even with high inflation, what we've been really trying to factor in, what the Fed has been trying to combat with these high interest rates, is essentially trying to cool down the economy and to get things to slow down to a more normal pace when it comes to inflation. Again, even though we've had like a cooled, I would say, jobless claims and overall ISM number, I think one of the things that we should keep in mind is that this is the intention behind some of the interest rates and the impact of it, rather than trying to increase interest rates prematurely and then seeing a increase in that inflationary rate going back up to unprecedented levels again.
Right, and let's stay with those interest rates. And what do you make of Powell's comments yesterday from Sintra, Portugal, especially on inflation? We know he said a lot of progress has been made, but he wants to see more before being confident about cutting rates. Does this change your upcoming view on the Fed cuts?
I think my opinions still remain the same. What Chairman Powell is trying to do and what the Fed is trying to do is to make certain that they're not cutting rates prematurely. We saw, I believe it was like last year in March, where inflation shot up, where we were seeing a slowdown in the economy, but then suddenly rates shot back up again to almost like 3.5%. And that was because I think we were kind of cheering on prematurely some of the gains that we had seen. So I think what the Fed is trying to do is making certain that those cooling effects that we've had on inflation is a steady one, and one that is going to be continuous, rather than one that might be based off of more summer or even seasonality effects when it comes to strong economy, strong jobs.
Right, interesting. And let's get to equity markets now. Nvidia and the AI sector with it really enjoyed an incredible run on the markets. Do you think this rally has legs? What do you expect for the rest of the year?
Definitely the rally continues to have legs. What we've been seeing a lot with Nvidia is that they continue to have very strong sales, especially when it comes to their H100 and H200 sales. Demand still continues to go up for those chips and those processors. So when we talk about the possibility, for example, of a stock split or how I would consider trading Nvidia going forward, I think that it's opportunity for a buy, but it's definitely heavily priced, or I would say overpriced in many ways. But again, I think if you want to be opportunistic when it comes to this AI bubble, or when it comes to the opportunity with machine learning, there are a couple of different stocks that I would look at in this space, but Nvidia is definitely one of my top ones in the space.
Moving to another hot topic, that's US elections. As you pointed out, I mean, we are seeing Biden's administration really taking steps to address some of the voters' concerns, such as new tariffs on Chinese goods, especially the auto sector, but also student loan forgiveness. What are the sectors that would be poised to benefit the most from these measures?
Some of the sectors that definitely be poised to consider when it comes to whether that's student loan forgiveness, we're looking at banks and looking at particularly private lenders. I mean, they would not necessarily benefit from it, but there's definitely some upside potential when it comes to the average Joe or the average person being able to have more discretionary income and therefore being able to spend more money in the economy. When we're talking about some of the work that Biden has done with the tariffs on China, that helps to promote companies that are within the United States. but it's also, again, like helping to bolster up some of our other allies, whether we're looking at Mexico and China as well, because those trade agreements are also getting bolstered at the same time while these tariffs are coming in. And one of the other things that I want to think about is just when we're thinking about some of the more jobs related acts that the Biden administration has constructed, this is helping to promote jobs in the in the infrastructure sector in the United States, and therefore helping to promote more domestic jobs and domestic opportunities. So I think that a lot of what the administration is trying to do is bring home a clear message of trying to create a much stronger economy, and one that is a stable economy for US workers and domestic workers, rather than one that is focused more on the international trade that we've seen in years past.
Interesting. So domestic strength. And one last point, Victoria, on asset allocation. One interesting thing that you pointed out is the rising stocks and bonds correlation, right? First of all, why is it happening? What are the implications for portfolio construction?
Well, one of the things that we've definitely been seeing is that there is a huge, I would say, re-correlation in terms of stocks and bonds. In the past, what we would see is that there was a huge outgrowth in terms of stocks out-earning bonds in previous years. And now that we've kind of seen that fluctuation kind of come back more into balance. And with that, I think one of the other problems that we're seeing is that stocks have become heavily, I would say, overpriced or overweighted in the 60-40 portfolio. So if we're looking for opportunities, whether that's in the alternative space or otherwise, that would allow us to diversify outside of the 60-40 portfolio or diversify outside of traditional stocks and bonds. This is where we believe that alternatives are coming into place, and particularly actively managed alternative ETFs are a great opportunity to basically capitalize on the same alpha that would be granted in a 60-40 portfolio, but with less risk and less leverage.
Very interesting. Victoria Beals, it was a pleasure having you on the show today. Thank you.
Thank you so much for having me.
And that is your Market Insight. Don't forget you can watch more videos on Reuters.com.